right, so now what do we know about this? We know that depreciation estimates, like how long is an asset going to be good for and all of those things, that's an estimate, right? How do we know if a car is going to be good for 5 years or 7 years? There's some standards that we go by, but who knows? These are estimates. The idea is that estimates change as you gather more information. So, let me move myself. GAAP requires the businesses to recalculate depreciation in the year of change and use the new estimate going forward. So for whatever reason, we decide an asset is not going to be as good for as long as we thought it was going to be, or whatever the case may be. Too far. We need to recalculate depreciation when we know when the circumstances change. So here we go. Let's look at this with math. Assume that Smith's Auto Sales paid $45,000 for equipment with a 15-year life and 0 expected residual value. So we're taking it easy on us. They're giving us no residual value. And we're going to assume straight line. Yeah, they tell us straight line. So we use this equipment for not 15 years, but we use it for 6 years. And then we decide it is not going to be good for another 9 years. It's only going to be good for another 5 years. So we need to recalculate that. Let's start off with the initial calculation. What would have happened when we first bought it? Well, it would have been 45,000 minus 0, straight line, divided by the number of years, 15 years. That's $3,000 per year. So if we did this in a T count, you'd see, and I did this to illustrate the point, you'd have the $45,000 for the equipment, and the accumulated depreciation, you would have had depreciated this asset for 6 years. So you've got year 1, year 2, 3, 4, 5, 6. Right? So at this point, it's $18,000. Right? That's my accumulated depreciation after 6 years of using it. So if I were to take 45,000 less the 18,000 accumulated depreciation, we would see that we have a $27,000 net book value. 6 years have passed, and that's what we decide. We look at this and we say, that asset is not going to be good for as long as we thought. It's only going to be good for another 5 years. So at the point that I make that decision as the accountant, we take the book value, the $27,000, we take the book value at that point, and we put it into the calculation as if that is a new cost. So we take 27,000 minus 0 divided by 5 years, because we're only doing another 5 from this point, right? The asset's going to be good for, I guess, in total 11 years. The 6 that have already passed and 5 more. So we come up with $5,400 per year. That means every year our depreciation going forward is going to be $5,400 instead of $3,000. So that's a requirement 1, right? Debit depreciation expense, credit accumulated depreciation, but for $5,400. And they ask what's accumulated depreciation at the end of year 7. Well, this is the first 6 years, $18,000. Now let's add in that $5,400 from year 7 here, and it'd be $23,400. That'd be the answer there. Okay. All right. Let's talk disposal. Okay, we're getting rid of assets now, right? We're working through the life cycle. We got them, we acquired them, we depreciated them, we acquired them, we maintained them, then we depreciated them, now we are getting rid of them. Okay, so the last piece in the life cycle is disposal. All right, so here we go. These are kind of your steps. They don't look like much, but they are. When discarding an asset, remove the asset and the accumulated depreciation balances from the records, and if not fully depreciated, record a loss. Let's show you those steps. Equipment with an original cost of $25,000 is discarded. The equipment is fully depreciated. So we had a piece of equipment we bought whenever for $25,000, and we have used it, and it has no residual value, and we're done. We've depreciated its entire life. We have no need for it anymore. So let's put that in the T count, because I just, like I said, think it's easier to see. This is what it looks like right now. Net book value, 0, right? So to get rid of it, how do we get rid of it? Well, we remove the asset and the accumulated depreciation balances. So the way we do that is we're going to debit accumulated depreciation so that we can zero it out, right? Debit accumulated depreciation, and we're going to credit the equipment. And now the equipment is 0. So basically what we're doing is we're just taking them right off our books by giving the alternating entry. So we debited accumulated depreciation, credited equipment, and now we're at zeros. And that is a simple disposal. Okay, we've done using it, gone. All right, now what happens if it's not fully depreciated? That's our next example. The asset has original cost of $25,000. We're discarding it for whatever reason. We're done using it. We've only depreciated at $20,000 worth though. So let's put that in there. So if this case, this asset really is worth $5,000 to me, right? That's its current book value. So if that's the case and we're tossing it, we're going to wind up with a loss. All right. So I say so a lot. Okay. Our journal entry, we take the asset off the books. We take the accumulated depreciation off the books, right? So debit accumulated depreciation, credit to the equipment, $25,000. And if you see, we don't match. And because we don't match, because we have a new one, new account, a debit is going to be your $5,000 for the loss on disposal of equipment. All right, where does this loss show up? Well, this loss actually shows up on the income statement. So you know how you have, sales minus cost of goods sold gives you gross profit, minus operating expenses gives you income from operations, minus, plus minus other. This is other. Gains and losses. They follow the same rules, like a loss follows the same rules as an expense would. A gain follows the same rules as revenues would, right? Because a loss brings the value down, right? So losses are always debits, same as expenses are always debits. Revenues are always credits, gains are always credits, the same as revenues are always credits. Hopefully you caught that. All right, that is what it's going to look like. Okay. Now what if we sell these things? Now we're not just discarding them, we're making some money. Well, these are the steps. Record cash, remove the asset and accumulated depreciation, record a gain or loss, if any. So let's do this. Equipment with original cost of $10,000 and accumulated depreciation of $7,000 is sold for $1,000. I like these T accounts because they help, and you'll see. You've got $10,000 equipment, you've got $7,000 in accumulated depreciation. So what is this thing worth to me right now? It's really worth $3,000 to me, right? 10 minus the 7, 3,000. That's my book value. And I'm selling it for 1. So what do you think I'm going to have here? I'm going to wind up with a $2,000 loss, right? If it's worth $3,000 to me and I'm only selling it for 1, that's a $2,000 loss. Let's see how that looks. Record the cash. All right, so we're going to debit cash for $1,000. Remove the asset and accumulated depreciation. Okay, we don't have to do that. We're going to debit accumulated depreciation for the $7,000 and zero that out. When I'm zeroing out, I will. And we're going to credit equipment for the $10,000. We've got $8,000 debit, $10,000 credit. What's left? There's the zeros. What's left is $2,000. Well, that $2,000 is a loss on disposal of equipment. Okay? Take the steps. Like I said, I know this doesn't mean much, look like much up here, these little bullets, but they are actually guiding you. You do the same things each time, really, if you're selling these things for cash. So we take it, the equipment has a value of $10,000, accumulated depreciation of $7,000, so it's really worth $3,000 to me. You can see that. We're selling it for $4,000. Yay, we're making money on it, right? So if we're selling it for $4,000 and it's worth $3,000, we made $1,000. That's going to be a gain. You know that before you even go into this problem if you lay it out this way. All right, let's take our steps. Record the cash, right? $4,000. We are going to take the accumulated depreciation off the books. We are going to take the equipment off the books. There we go. Let's zero them out. There is 0, 0. And $11,000 on the debit side, $10,000 on the credit side. We need another $1,000 there. That's what we said. That credit is going to be a gain on the disposal. All right. Okay, so there we go. We got a loss and a gain. Now, what happens if we get rid of an asset mid-year? Okay. It happens. Like I said, not everybody's disposing of things on December 31st. This is pretty normal. Remember we did that partial year calculation of depreciation earlier? Let's do the same thing here. All right, disposal of an asset mid-year. So the first thing we have to do is we have to catch up that partial year depreciation. Because if we use an asset for part of the year, but we don't depreciate until the end of the year, then we need to record the depreciation for the time period where we did use the asset. Step 2, record the cash. Step 3, remove asset and accumulated depreciation. Step 4, recording gain or loss. Steps 2 through 4 should look pretty familiar because we've been doing those. All right, let's do this with numbers. And of course they made this more complicated, and it has to be because they threw the double declining balance in here. But let's do this. Comfy clothing consignments purchased, showroom furniture for $17,000 cash, expecting them to remain in service for 5 years. They depreciated on DDB, right? Double declining balance with zero residual value. On October 31st, they sold the fixtures for $7,600 cash. Okay, so let's take this apart. Double declining balance. Actually, you know what? I'm going to go on to the next video because it will take too long to go through this. So meet you in the next one.